It is my great pleasure to be presenting to you on the last day of COP. Thank you for making the effort to come out. I know it's been a long 2 weeks. I have a great panel for you today. And I will first, my name is Barbara Davidson, by the way, if you don't know me. I'm a senior analyst at Carbon Tracker. And I'll be giving you a presentation, and then we're going to have a really great panel sitting up and having a panel discussion. Then we'll go through some Q&A with the audience, and then we'll have a final presentation from David Pitt-Watson, who will be online with us. So first, what I'm going to do is give you some background about some work that we did about accounting for the financial effects of climate-related risks in financial statements. So we're talking about financial statements, just to be really clear. This is the back end of the annual report. These are the audited financial statements. These are not the sustainability disclosures or TCFD reporting. Even though that is very important information, we're talking about the financial statements. So in September of this year, Carbon Tracker published a report called Flying Blind: The Glaring Absence of Climate-Related Risks in Financial Reporting. And this report provides the results of an analysis that we did of 107 companies. We did this work, Carbon Tracker, in conjunction, in collaboration with the team, the Climate Accounting Project, who was commissioned by the PRI. So the Climate Accounting Project team and the Carbon Tracker team analyzed 107 publicly listed companies. These companies are operating in various sectors, but they are primarily in carbon-intensive sectors, including energy, industrials, and transportation. They're mostly located in the US, UK, and the EU. Now, these companies are important also because most of the companies form a group of focus companies by the CA100 or Climate Action 100 Plus investor group. So these companies are already being targeted for engagement with these issues. And also, because they form a group of these companies, they're part of a larger group that is responsible for over 80% of global industrial greenhouse gas emissions today. So already, we're starting with a group of companies that we would expect that will be impacted materially by climate-related risks. So we looked at their reporting, their financial statements, and we also looked at the audit reports for 2020. For consideration of the financial impacts of these risks, I'll talk about what that means in a minute, consistency in reporting, and for Paris alignment. Now, the other reason this review is important, because it comes off the back of clarifications by accounting standard setters and audit standard setters, and one of the people who helped write a clarification for the International Accounting Standards Board is here with us today, Nick Anderson. In 2019 and 2020, that this information is relevant to current financial accounting standards today. We do not need new accounting standards. And the international auditors have said the same thing, Auditing Standards Board. Basically, this information, if material, should be considered by auditors today. So we were off the basis of that already. In addition, in 2020, investors that represent over 110 trillion assets under management, so investor groups, such as those that were gathered by the PRI, Principles for Responsible Investment, such as IIGCC, such as individual investors that sign these letters, such as Ceres and CalPERS, who will also be participating in our panel, signed letters to companies saying that this information is important for them to see in financial statements, and they want to see how the auditors have dealt with these issues. So this is the background for the analysis we did. I mean, this information, we're expecting to see this when we did the analysis, and it's required if the items are material. And based on the companies that we looked at, these items are material. So what are the results of our analysis? Well, the results were pretty disappointing, we have to say. So this is all in the paper that I mentioned. 70% of the companies that we looked at, remember, these are carbon-intensive companies like Chevron, Exxon, Total, BP, but also Volkswagen, BMW, Rio Tinto. 70% of these companies gave no indication that they considered the effects of climate-related risks in their financial statements. So what does that mean? That means, for example, if there are policies or regulations to reduce emissions, to phase out the use of their products, such as coal or internal combustion engines, such as their own electrification, their own decarbonization plans and targets. We did not see how or whether they considered the impacts of these on productive asset lives, residual values of such assets, if they were doing impairment testing, we did not see if declining commodity prices were considered in estimated future cash inflows for these companies. So were their estimated cash inflows when they impairment tested the assets, were these going to decline? Were they going to have increased future estimated cash outflows because of abatement costs? We didn't see this. Were their asset lives going to be shorter because of transition policies? For 70% of companies, we couldn't see this. Did they have accelerated decommissioning obligations? Did they have inventory that might be obsolete? Did they have contracts that could be onerous? We don't know. In addition, only 25% of the companies we looked at provided the quantitative information that they use when they prepare financial statements. So when I say quantitative information inputs, I mean now, what are the actual commodity prices that they use if they're impairment testing? What are the actual lives that they used for these assets? The number of years? What's the time frame that they think they're going to need to decommission these assets? We didn't have this information. And investors need these quantitative inputs to understand the extent to which climate's being considered today, and so that they can do their own adjustments if necessary. We did not see this information at all for these companies. Additionally, for the audit reports, only 80% of the audit reports that we looked at did not provide evidence of consideration of these issues when they were performing their audits. So what we did was we looked at the key or critical audit matters in audit reports, as that's where we expected to see this information. And key or critical audit matters will typically discuss significant judgments and estimates that management has used in preparing the financial statements, as well as the auditors, what they need to consider when they're auditing. And because of the nature of energy transition, decarbonisation, I mean, this is all based, it's uncertain, right? So it's based on significant judgments and estimates. So we would have expected to see a discussion of consideration of these issues in the audit reports as well for these matters, such as impairment. So again, asset impairment testing, that depends on future estimated cash flows. So those could be materially affected by, they will be, for many companies, materially affected by the energy transition. 77% of the auditors we looked at included impairment as a key audit matter or critical audit matter. But only 25% of those auditors talked at all about how they considered the effects of the energy transition when they were testing the assets, when they were testing management's impairment. So there needs to be more transparency in this. That's poor results. We'll maybe come back to this later during the panel, but we also saw a significant difference in both financial statements and audit reports across jurisdictions. So the US was notably very poor. None of the auditors for the US companies discussed these issues in their audit reports at all. And we're talking about, again, big companies like Exxon and Chevron. Now, we also looked at the consistency in financial reporting of these companies. 72% of the companies were inconsistent in their reporting. So what do I mean by that? Well, we looked at the information outside of the financial statements. So now we started looking at sustainability reporting, information risks discussed outside the financial statements in the front, if you will, of the annual report, SEC filings. Do they discuss material transition risks? Do they discuss their own energy transition strategy? And even if they didn't, but if they did, because they're telling a story, what do the financial statements say? Again, if they have an energy transition strategy, so they're going to reduce emissions in the next 10 years, how are they justifying asset lives to continue to be 30, 40, 50 years? If they're talking about electrification as a car company, how is that affecting their current inventories today? Will it affect their inventories today, their leased assets, the residual values of those, the receivables that they're holding for those? Are those affecting them today? 72% of the companies were inconsistent when we looked at this. In addition, and I mean, this could mean, material misstatement in the financial statements. This could mean greenwashing. We don't know, based on this consistency, what this means. Additionally, auditors are required to read the other information as part of their audit, and other information is defined differently in the US and then in other jurisdictions. But effectively, auditors read other information, they look at the financial statements, they want to make sure there's a consistency between them so there's no material misstatement in the financial statements. 59% of the auditors, so when we did this, we made sure we were looking at the information that auditors are required to look at, not anything outside of that we made sure we didn't include in our results. But 59% of the auditors provided no indication of the inconsistency that we found, and they are required to say something in their audit reports if they find it or how they've dealt with it. We didn't see this for 59% of these auditors. So again, this is a big problem, and the impacts of ignoring, if this is what's happening, ignoring these issues can lead to overstated assets, overstated profits, understated liabilities, significant capital at risk, misallocation of capital, and so effectively missing our chance to achieve the goals of the Paris Agreement. So the last thing we looked at in our work is the Paris alignment of financial statements. So understanding that this is not required today in current accounting standards and audit standards, investors are still asked companies to align their assumptions and estimates with achieving the goals of the Paris agreements, or show a sensitivity of their financial statements and the relevant items to using assumptions and estimates that are aligned with the goals of the Paris Agreement. What does that mean? That means assumptions and estimates that are aligned with achieving net zero by 2050 or sooner, and no more than 1.5 degree warming. And so we looked to see, and investors also asked auditors to assess if companies have done that, and if not, please provide a sensitivity to this information as well. So we looked to see if companies have done this. Now, only 7% of companies even explained the scenarios they looked at for their inputs. So we didn't know what other companies were using. 7% explained they used some of the International Energy Agency's scenarios, such as the Sustainable Development Scenario, but for us, that wasn't going to achieve the net zero 2050 1.5 degrees. So none of these companies were Paris aligned, but some of them, small percentage, showed some information. On the audit side, only 9% of the auditors even addressed this investor request. And of the 9%, one auditor, Shell's auditor, basically indicated that this assessment was outside of its remit or its responsibility or its expertise. So it acknowledged the request and basically said, sorry, too bad, we're not doing it. So again, if without this information, even as on a sensitivity basis level, because if companies management think, okay, we're not going to use these estimates and assumptions because our best estimate is something else, if investors don't have the information, the sensitivity of a company to this information, they have no way of knowing how the company is going to achieve how are they going to stay in business? Can they achieve the goals of the energy transition or their own goals with the information in the financial statements today? Again, are assets overstated, liabilities understated? There's no way of assessing this without this information for investors. And of course, the investors that we have here today will talk about this some more. Okay, so what's next? Well, we all have a role to play going forward. Companies clearly need to provide better disclosure about what they've done or haven't done in their financial reporting. They need to improve their governance over these issues. So at a board level, audit committee level, they need to ensure that this climate-related information is included in their risk management systems, internal control systems. And they need to the audit committees need to discuss this with their auditors. Auditors need to provide better transparency over whether they have assessed these issues and what they've done about it. And if not, they need to give us signals as to what they're doing to start doing this. Internal training. How are they working with companies and audit committees to achieve this? Regulators, they need to start identifying if companies have done this. Have they incorporated material climate-related risks, the financial impacts of these in their financial statements today? And they need to increase their enforcement and oversight of these issues. And we're seeing a little bit of this now. And the FRC did a climate thematic in 2020. ESMA came out with their enforcement priorities for 2021 financial statements, and they're saying that they're going to look at consistency in reporting. The SEC is doing a climate disclosure consultation. So we're seeing some activity, but they need to step it up. The information that we've seen in financial statements today is very poor, especially for U.S. companies. Big oil and gas companies. And investors need to make their expectations clear with companies. And they need to engage with management, and they need to think about the impacts, the information we found in our report, and the impacts on their engagement and their voting and their capital allocation decisions. So with these small things, thank you for listening to my presentation. We're going to go into a panel discussion with, like I said, this fantastic panel that we have. Can I invite the panelists to come up, and I will introduce you all, and I will go sit down. And I'm sorry, you still have to hear me talk.
Oh, come on, that was great.
Yeah, thank you. We're finished. Everyone can go home now. I'm finished. No. I don't know if we need I guess the slide's just going to stay like that. So let me, oh, is that okay? This is like really close to me. Okay, so I know, I feel like, I don't know, I feel like this is kind of cool. So let me introduce the panelists first, and then I'm going to go through some questions that we've already discussed before we open it up to the audience. So right here, starting from your left to right, we have Ann Simpson, who's Managing Director at CalPERS, a large U.S. pension fund, for those of you who don't know CalPERS. And she's also, CalPERS is also one of the conveners, is that right, of the Climate Action 100 Plus, which we can talk about some more. Ann can talk about that some more. We have Nick Anderson, who is a board member at the International Accounting Standards Board, not to be confused with the Sustainability Standards Board, whoops, which was announced at COP last week and is under the same umbrella of the IFRS Foundation, but this is the accounting standard setter. So those standards are already here. We have Natasha Landell-Mills, who is a partner and head of stewardship at Ceres and Partners. And then last but certainly not least, and thank you so much for being here today, we have Bridget Beals, who's a partner and co-head of climate risk and decarbonisation strategy at KPMG. We'll also have David Pitt-Watson, who's on video, present some closing remarks, and I'll introduce him again later towards the end. So thank you once again, everyone, for being here. I'm very, very pleased to have you. Can we, starting with you, Ann, can you expand on why investors are asking for this information? I talked about it a little bit in my presentation, but we'd like to hear more about why investors need the information about climate-related matters in the financial statements and how you use this information.
Well, thanks very much, and thanks to everybody for coming here. Who would have thought that we'd be talking about why the bean counters have never been more important? And I was just thinking about an analogy, that we can all understand. If we go to buy a tin of beans or a can of beans, as the Americans would say, we expect that the label on the tin is going to tell us what's in there. And if we took that tin home and off we went on our little vegan supper, opened it up and found either that there weren't the beans we expected or that the label was wrong, and we'd paid money for something where we simply hadn't got what we'd asked for and what we'd paid for. And really, that's what accounting is. And the big tin of beans at CalPERS is almost $500 billion, which is working people's money that we have a fiduciary duty to invest. And every dollar that we pay out in California to, our members, there's 2 million or so members that we have, 55 cents of every dollar comes from investment returns. So if we are not getting the bean counters to make sure those beans are in the tin, we are not putting food on the table, benefits on the table for nearly 2 million working people in California. So that's the simple reason why the accounts matter. But the other thing I wanted to mention is that not only are pension funds like CalPERS the largest pools of financial capital in the global economy, that's important to understand. We have a fiduciary duty to produce these risk-adjusted returns, not this year, not next year, but on an intergenerational basis. Then these long-term risks and the opportunities from issues like climate change are going to underpin our ability to do that. So after the last but one financial crisis, CalPERS sort of went back to the drawing board to really think about investment in a new way. And what we came up with was a framework in which we say in our investment beliefs, for sustainable value creation, which is our day job as a pension fund, we need to understand that there are three forms of capital that need to be effectively managed: financial, human, and natural capital. And in a room next door in this lovely tent, there is a discussion on the just transition, which is a shame we can't combine these two groups, because the impact of climate change on the workforce, on communities, on vulnerable supply chains is as important, and we need to be able to account for that too. So let me then answer quickly, so what do we do about that? So although CalPERS is very big, we also always need to work in partnership with other investors. So we convened the Climate Action 100+ initiative, and Carbon Tracker is one of the technical analytical groups that supports this. We have now an almost $60 trillion signatory base to this initiative. So that says it's not just good old CalPERS in California with our beneficiary elected board and that stakeholder philosophy that is important to us. We've got $60 trillion recognizing this. And what we've done, as Barbara mentioned, is identify what we're calling the systemically important carbon emitters. These are the 100+ companies in the world responsible for about 80% of the emissions. But what we want to do is use the force of this money to make sure that these companies develop sustainable business strategies and then report upon them. And this is where the accounts come in. And the potential we have now through, I say, we have just integrated accounting and audit into the benchmark, if you like, the measuring stick by which we're assessing these 100+ companies. What we're doing is moving into not just the talk, but the action. So you're seeing important initiatives like holding board members accountable. I think the Exxon example this season was the epitome of that sense of accountability, not just transparency being necessary. So I think with this work that Carbon Tracker's been doing that's so important to us, by including accounting and audit into the benchmark, we're setting the stage for investors considering their fiduciary responsibility when they are voting on audit committee members and when they are voting on the reappointment of the auditor. So there's an opportunity to put this right, and it will have major impact on our understanding of risk and opportunity in these companies. But that is the fiduciary duty, that is the day job of an investor like CalPERS. So we appreciate this work, it's phenomenally important, and I would say all praise to the IFRS for taking the lead on this, and also the defenestration of the PCAOB appears to have been ended. I see Damon Silver's here, sat also on the investor advisory group there, also at the SEC this issue's on the agenda. So, but investors need to keep pushing the regulators to get the information that we need. So thanks, Barbara.
Thank you, Anne, for that. Keeping with the investor vein, Natasha, I mean, I mentioned briefly the differences that we found in financial reporting between the US and the EU, UK, and I think part of this we think is probably due to investors like Ceres engaging quite significantly. Not to, I mean, obviously CalPERS as well, but we've seen some direct engagement with the auditors and audit committees. So can you explain maybe a little bit more the engagement process that you go through? You go through at Ceres and what you think has worked, and also how companies have reacted to this engagement.
Yeah, absolutely. Can you hear me? Yeah. I just wanted to start before doing that, and I know I've got 5 minutes, but just to underscore what both Barbara and Anne have said, just really in one line, which is, you know, until we get 1.5 degree aligned numbers, we're not going to get, in our view, a 1.5 degree aligned capital allocation. So it's what investors need to see in their deployment of capital, but it's also what management use in determining their deployment of capital. And in the end, that is actually really what matters here. So to answer the specific question about engagements, you know, we started back in 2017, and you know, at that time, knowing the importance of accounts in terms of capital allocation, we decided to do a deep dive into the oil and gas majors in Europe, and in particular Shell, Total, and BP. And we just wanted to see what they were reflecting in those financial statements. And what we found was just radio silence, as Barbara has indicated, and that's 3 years on. Really, there was no mention, not only of the Paris Climate Agreement, right? There was no mention of decarbonisation, which was happening at the time. So in essence, balance sheets were being drawn up based on critical accounting assumptions, which I should stress are forward-looking. Accounts are based on forward-looking assumptions, right, that assumed that demand would continue for their product, fossil fuels, into the future as it had in the past. They were BAU, business as usual. So in other words, and the question that we then asked in a paper that we published at that time, were these entities actually overstating their capital? And that is a plain vanilla issue of misrepresentation. That was a question we asked, because really to not acknowledge a structural shift that was underway was really clearly pretty dramatic in our mind. So fast forwarding, we entered into engagements with those companies and others. We have worked with the likes of IIGCC, clearly Carbon Tracker as well, and many others, a growing coalition. I think we started with 2 trillion in AUM, and have now, as Anne has mentioned, we've got the PRI, which represents over 100 trillion, now asking for net zero aligned accounts. And what have we seen? So where we have focused our energies, particularly in the European oil and gas sector, we have seen long-term commodity price assumptions coming down. Now, that is a critical assumption in those companies. Every company will be different, but in those companies, that's a critical assumption that will be affected by decarbonisation. We've seen those come down. Shell has come down from $80 a barrel to 70 to today 60. BP has come down from roughly 75 to today 50. Total likewise, Eni likewise. So we have seen those come down, and with that, we have seen tens of billions of impairments. And that is the tip of the iceberg, right? This is just the beginning. The IEA's projection for the net zero, for its latest net zero scenario, is seeing oil prices coming down to, just over $30 a barrel. So what will come through next? We've also seen some sensitivity analysis, which is something we've asked for. BP, for example, has told us that roughly 45% of its plants, property, and equipment, which is one line item on the balance sheet, is at risk from lower commodity price assumptions. That's over half of that line item, PPE. But that doesn't even tell us about joint ventures. That doesn't tell us about goodwill. That doesn't tell us even about deferred tax assets, all of which are impacted by this assumption. It's partial, but it's a start. We've also seen the auditors, who we have engaged with, and in fact we released our latest letter to the Big Four in the UK last week, at the beginning of last week. We've seen them increase their disclosure in certain cases. So Barbara mentioned Shell, EY. I'd actually like to call them out for having a whole page in the annual report and accounts dedicated to answering investor expectations. Now, yes, they need to do more. And yes, in that they say Shell is not Paris aligned. But that is important that they're saying that, the auditor saying that, alongside management saying that, by the way. But what they didn't tell us is what would Paris alignment mean for their numbers. That's what they haven't said, and that's what we need to know. BP also, Deloitte, I'd like to call them out. They've done some very detailed disclosures in the auditor report to shareholders. So we've seen clear progress. In terms of what's worked, and I probably point to sort of 3 important elements as part of this initiative, and just underlining it, we have not gone far enough, but what has worked? The power of the argument. The fact is we've identified a demonstrable failure in the system. The auditors and indeed companies are not implementing existing standards. So having that argument has been really key in ensuring that we get the traction, not just with the companies, but with the regulator as well as the audit firms. Secondly, we've had supportive regulation and standards. So Nick's going to talk about the IASB, but we've had the International Accounting Standard Board, the IAASB, excuse the acronym, the International Audit and Assurance Standards Board. Both have issued guidance telling us that material climate risks need to be in the accounts. And by the way, when you have over 100 trillion of investors saying, we want to see this, that makes it material. So we need to see disclosures in the accounts, not just of, a, let's say, 2.1 or 1.8 degree pathway. Investors are asking to see what the financial impacts of a 1.5 degree pathway will be. So supportive regulation. And then finally, I would say engagement with audit committees as well as auditors. These are individuals or groups who have not historically been engaged with by investors, and perhaps are finding it a little bit difficult. But actually, we've had some very constructive conversations, and I think that's been part of the reason that we've seen impacts where we have. But again, we need to do more. Thank you.
Thank you, Natasha. So moving on to, everyone's clapping at Natasha's. So moving on to, you could have just done my presentation up there.
I thought you were complaining I took too long, sorry.
That's okay.
No, I did that, I'm so sorry.
I'm going to cut everyone off soon. Nick, going to the International Accounting Standards Board. We talked already, we've already been discussing the risks that are missing from financial statements, and that accounting standards require a lot of this information today. So, maybe backing up a little bit, can you talk a little bit about what the accounting standards, do require?
Sure.
In this area?
Sure. No, thanks, Barbara. And let me back up a little further than that and just remind you or paint a picture of how accounting standards fit in, particularly IFRS standards. So the standards, which are produced by the International Accounting Standards Board, are used in 144 countries around the world. They're required to be used by those countries. Those countries choose to use the standards, and they're permitted in another 12. The main jurisdiction that doesn't use those is the US, which have their own set of standards. Now, we set the standards as a board. It's a privilege to do that. Our mandate is to set those standards. We do not have a mandate to enforce those standards. That enforcement responsibility is within each individual country. So it's a powerful position as it is even to set the standards. Our standards are principle-based. So if we have a big book, if you go to our book and you look through the index to find climate, you won't find it there. But nor will you find COVID either, or pandemic, because they're principle-based. They apply to different circumstances, different events, different transactions. We don't set out to specify when and where the standards should apply. Indeed, if you do a word search, you won't find climate either. So it was probably 3 or 4 years ago, we're starting to hear from a range of investors, why don't you say something about climate? Why don't you do something about climate? And the reality was we already were, but it just wasn't very transparent how the standards applied to climate-related risk. And that led to an article that was published 2 years ago this month that laid out which standards could apply to climate-related risk. And let me just highlight a few of them, and I'll talk about 2 in further detail. So it could be around the useful life of an asset, which is clearly pertinent in this discussion. It could be around provisions, again, very relevant, contingent liabilities. It could be around the fair value you put on the loans that you've given. So again, all critical issues. But the 2 areas which I really like to highlight, the first is around the potential for impairments, writing down the value of an asset, of goodwill or other assets, PP&E, and so on. And that goes to the issue around stranded assets in particular. Now, I think what investors often look for in terms of this area of accounting is what were the assumptions that the company was using in doing its impairment test. And we saw the results of the study that Carbon Tracker have done, that only 25% of companies produced information about their assumptions. Now, those assumptions are important to investors, I'd say, for 3 critical reasons. So firstly, are what you have in the numbers, the back half of the reporting accounts, consistent with the story that you're telling in the front half with your strategy? Investors want to build trust in the companies they're investing in. They want to build trust in their investment case. Having a consistent story helps to build that trust. Secondly, are those assumptions, they're around issues such as growth rates and commodity prices. Are they consistent with my view as an investor of the world? Does this make sense to me on a long-term basis? I want to verify, I want to be comfortable with those assumptions. And the third area where assumptions are critical is clearly one would expect particularly in terms of commodity prices, it's the same assumptions that are feeding into a company's capital allocation decisions. And without being comfortable with that those assumptions are correct, we may feel that we have a misallocation of capital. So there's a great focus around the piece around impairment, around the assumptions, backing that test that companies undertake to whether they need to write down the value of the assets. So that's one very important part. The second one is a little vaguer, but equally important, if not more important, and that's how we think about what information you have to disclose in your financial statements. And so we have some overarching requirements, and we have this in a standard called Presentation of Financial Statements, IS1, and it's like an operating manual for those who are producing accounts. And it says you need, whatever the requirements say, if there's something that's missing in the context of the financial statements and it's material to investors, insofar as you could change the decisions, you have to provide that information in addition. You need to do through the prism of the investor view. And we go one step further than that in the standard. We say, often people think materiality, well, that's about size. So if it's a big thing, you're going to tell us about that. But we go one step further. We say, no, it's not just about size, it's about the nature of the item as well. And the board's gone one step further than that. It produced some further literature in 2017, which actually said in some circumstances, if the size is actually even very small, even 0, it's relevant to produce that information because investors are worried about it. It's a concern, even that information that there is no exposure could drive share prices. And so we really need to hang on to that view that accounts are for investors. It's about those issues that will drive their decisions, drive their stewardship of companies, and thinking not just about the specific requirements, but the general requirement also in combination with those to help investors in their fiduciary roles that both Natasha and Anne have highlighted.
Okay, thank you. I think I'm glad to hear that the standards are actually supporting what we were looking for as well. So thank you. Bridget, last but not least, and thank you again for coming here and fielding our questions today. So, we've seen in some audit reports that auditors are starting to at least disclose that they're addressing these risks, climate-related risks in their audits. What are auditors doing to address this? And what are the challenges that you're facing? And can we expect the audit report disclosures to evolve, since we didn't see, as much as we had hoped to see in our analysis last year? So if you can, so what are your challenges? What are you doing today? And then also, how do you think it might change in the future?
Yeah, thank you, Barbara, and thanks everyone for having me here today. I do think it is really important that the Big Four are here being part of this debate. There is only one side in the war against climate change, and we absolutely want to be part of that constructive dialogue. So I've been working in climate change for about 14 years now, and I can honestly say that the last 24 months have been the biggest acceleration of my personal understanding of how climate change impacts every facet of our society. And I think that's incredibly important context for the conversation we're having today. And I think there's 3 key ways that our understanding and our knowledge about climate change has changed over that time. So the first is our understanding of physical risk, the second is our understanding of transition risks, and the third is our understanding of systemic nature of those risks. So I'm just going to talk a little bit about each of those and why that's really important for considering climate change in financial accounts. Then talk about what that means in terms of the audit profession, and crucially, where we can start to see some of that building understanding reflected in those accounting principles as we move forward. So when it comes to physical risk, I don't think there's a person in this room who would disagree that the sort of nature of the climatic conditions that we're seeing reflected around the world are changing very, very rapidly. That's both the frequency, the severity and the velocity of the change that we're seeing in that physical environment. And the climate science, the climate modelling is improving all the time. And particularly, that climate modelling around some of those tipping points, that hysteresis effect, and those feedback loops between those different physical environments. We're still in an immature stage in that understanding, but indeed we are building that understanding as a global community. And the second key part of this is transition risk. So the UK came out just not even 2.5 years ago with a net zero commitment. And they were the first in the world to make that public commitment to becoming a net zero economy by 2050. We sit here just 2 and a bit years later. I haven't actually done the maths on what India, Saudi Arabia and Australia signing up to is, but we are now in excess of 85% of global GDP signed up to a net zero target. Underpinning that, you have now thousands of corporate entities who've also signed up or committed to signing up to science-based targets through the Science-Based Targets Initiative. The speed of change within which that is happening and the impacts in terms of the thinking, the buying decisions, the investments, the research and development, I don't think we can underestimate the pace of that change. And then thirdly, the systemic risk point. I was speaking to a CFO in the travel industry recently, and he said to me that prior to COVID-19, their 99th percentile COVID risk that they considered for the downing of planes in the travel industry was 2 months. That was the most systemic nature of the risk that they could consider was 2 months long. Now, all of us who've been living through the last 18 months know that is not the world we live in. Our human ability to envision that systemic network effect that risk has through our supply chains, through our economies, we will always understate that risk in terms of how we start to think about it. And COVID has been an incredibly important line in the sand for us to start to increase our understanding and our ability to start to model that through our economies as we move forward. So, does that mean that climate change hasn't been considered in past accounts? Absolutely not. Climate change has been considered through the audit process in previous years. But I think it's fair to say over the last 24 months, reflecting all that building knowledge, all that change that's come through, the building regulatory environment around the TCFD and how we're starting to think about bringing all these things together, we can expect a change in the way that is reflected in financial accounting as we move forward. The way we're thinking about that at KPMG, I can't speak for the other big four, but we talk to our clients about aligning strategy, risk, and finance. And that has two crucial implications. The first is that, if you are a net zero company, if you have assigned yourself a science-based target, if you have interim targets, and you're making those public commitments, then there is a building expectation that you will start to reflect those cash flow commitments through the CapEx commitments that you'll need to make into that back half reporting. I think that's a minimum expectation as we move forward, that those plans are really clearly laid out. And the Task Force on Climate-Related Financial Disclosures has been really clear that transition plans, and indeed the UK government through its Green Finance Strategy recently has been really clear about how they expect this sort of universe of reporting to start to come together over the next several years. The second key part is that risk element, and the TCFD is now mandatory for UK premium listed companies. The TCFD does recommend that companies are undertaking scenario analysis around a 1.5 degrees aligned trajectory. And I think we can reasonably expect that companies will be starting to perform some sensitivity analysis using those 1.5 degree scenarios consistently through the front and the back half of the reporting. So over the next few years, as that starts to come together in a more cohesive way, as management teams of premium listed companies come on that same journey that the whole market is on, I think we can safely assume that there is going to be enhanced disclosure around how companies are thinking about climate change. And invariably, that will result in either complying or explaining what they've considered, how they've considered it, and why, in many cases, they've deemed some assumptions immaterial, so that users of the accounts can actually start to understand that thought and that logic process.
Okay, all right. Well, I'll come back to you in a minute. So I just have a few more follow-up questions to ask people, and then we'll open up to the audience. And I would encourage, if the other panelists want to answer, that's fine as well, but I'll direct it to specific people to start. So Nick, coming back to you, we've been talking about what we didn't see in the financial statements. So do you think what do you think the reasons are that companies might not be including this information in their financial statements today, based on the financial reporting standards?
Well, I don't know the answer. I know what some of the answers could be, but I don't know why. So let me run you through some of the possible scenarios, and I think some are more benign than others, is the reality. So we go back to the article that was published 2 years ago. The first response to that article, and it was an article in my name, it wasn't from the board, it wasn't from the foundation, it was sort of unhelpful that some people referred to that as Nick's article or the Anderson opinion.
The Anderson opinion.
And actually personalising it, in some respects, undermined it, because people would say, well, that's just Nick's opinion, we don't have to follow that. So a year later, the foundation followed up with further material, which actually effectively mimicked what was in that first article, but it came from the staff of the foundation. It has more gravitas, it has more weight. People can't dispute that it is the view of the foundation. So that's the first thing that we did. I think partly tied to that, and that may have made it too late it came out in November last year, too late for the annual reporting season, possibly. But I think part of that ties into probably what Bridget was referring to, that there's some fairly big cultural change that has to happen here. And what is important, because investors are looking for consistency, is that strategy, risk, and financial numbers are aligned in that. Now, that does take time. We haven't got time also, so we do need to be getting on with that. But I think there's some human nature that comes in here, moving to a new way of thinking, a new way of reporting, and we just have to be cognizant of that. And then we go into the less benign explanations. And so the first one is how materiality is thought about. And I've heard this in a number of different places. There was no information on it because it wasn't going to have a material financial impact. And in brackets, it says within the next 3 years. Well, actually, that's not the board's definition of materiality. And just it goes back to what I was saying before. This is by magnitude and by nature, or combination of both. It's driven by what worries investors. Sure, investors are worried if something has a material financial impact, but investors have a long time horizon and worry about all kinds of things. So if this is in the context of the financial statements, we can't be reporting on everything investors worry about in the financial statements, but in the context of the financial statements, and they are because you have assets and liabilities around these things, yes, you'd expect that type of reporting. So I do worry. I've heard that in a number of different guises, and that's something which we will think how we can address that. And of course, then you may just have a category as people just don't want to go there, just uncomfortable about it. I hope it's largely the second category, that it's a time, it's a cultural thing, it's an evolution. I worry that it's some of the third. I think the first and fourth isn't so much. But I do have, I just to finish really here and thinking about the words, that there's an organisation in Europe called ESMO, which is the European Securities and Markets Authority. So this is the collection of regulators from across Europe who publish their enforcement priorities, what they will be looking at in 2021 report and accounts, and what local regulators should be looking at. And they had some very strong words in there. You need to think about declaring assumptions. You need to be thinking about impairments. You need to think about the nature as well as the magnitude of information when you're considering materiality. And actually, it was very aligned with the material that the board had put out. But I think now that again, as I say, the board is not a regulator, it's a standard setter, but now we have the regulator actually reinforcing these points at the same time.
Yep.
And I think it probably leads fewer hiding places if companies are wanting to hide from this. But they struck me as very strong words from
So
ESMA.
I know Anne wants to come in. I just want to ask something about what you said before that. So you said it's not material within the next 3 years. Where was this in financial statements? Where did you see this?
So this is a supposition from me. So
Okay.
it's, to be clear, so it's almost, I haven't seen that written, to be fair.
Okay. Just
But I think it's almost
making me
human
nervous.
nature that these things get captured, and it may be, what the company's budgetary time horizon would be, which could be 3 to 5 years, perhaps for some. And again, the ESMA guidance says, actually, these are long duration risks, and investors, although they may appear soon, investors are worried about them in that respect, and just because they may happen over a longer time horizon, you can't ignore them.
Right. I mean,
Yeah.
IFRS is pretty clear about that
Yeah.
too. But
Yeah.
let me go ahead, Anne.
Yeah. I was saying to Nick earlier that actually I like this idea of this work being the Anderson shelter. Because
some
my
people-
parents' generation, this is what everybody ran to when the bombs were falling. It was the place that was going to keep you safe. So it's okay. But the important thing is it's now, the rule makers have adopted this way of thinking. There's another thing at work, and that is we pay executives on short-term cycles for performance which is increasingly attached to EPS, total shareholder return. And that's a shift over maybe the last quarter of a century, where we've shifted the incentives in businesses away from looking at the long-term value drivers in the company and making them a bit more like a short-term play in the stock market. Now, that's called compensation in the United States, remuneration in the English-speaking world, and
The United States is not an English-speaking world?
it's American. I'm just leaving
don't
it there.
understand.
And I am a resident alien in that wonderful country, so I have to speak with due respect.
Yeah, exactly.
It's on
Yeah.
my passport. Don't laugh, Americans in the room. I genuinely met an alien today on this panel. How about that? Anyway, back to the plot. The issue of how markets work, there's two things. One, information, and everything that we've been talking about is about information. But the other thing that drives markets is incentives. Now, we've got the big macro discussion about carbon pricing and removing subsidies from fossil fuel, all that jazz. But at the micro level, at the company level, the incentives that we're putting in play are giving us the results that were intended, which
Yep.
is a short-term focus on the share price. And everything that Nick and Bridget and Natasha are talking about could have an impact on the share price of these companies. So unless we untangle the incentives and rethink compensation, remuneration, and bonuses in a new way and get them aligned to emissions targets reductions, we're not going to get the decisions that we need. And again, all praise to a number of the Climate Action 100 plus companies. I see Oliver Grayers here who's done a lot of this fantastic work. Thank you. But we've called on these companies to not only sort out their political lobbying, their emissions targets, their CapEx alignment, now the just transition, the accounting and audit. We also want the compensation schemes, remuneration and rewards, to be aligned to these long-term goals. And if we don't get that, it's going to be very... how can we be surprised at what we're getting at the moment? So again, think about engagement, think about the proxy votes. There are committee members responsible, and in many markets there is a say on pay. So maybe at this point, the next bit of work we all need to be doing is saying, are these pay packages aligned? Is this a Paris pay deal? Or is it something that's designed to mean that you focus on short-term issues, you interpret materiality within this short-term cycle, as Nick was saying, which is not what the regulations require, either in the US or in IFRS, and get incentives internally in the company aligned to Paris. That's just another missing piece in the picture, I think.
Yeah, I mean, I would say that when we looked at the financial statements, because that's part of, I think, IIGCC's expectations said that as well, and we looked at whether remuneration was aligned with some of the emissions targets that were
Right.
being set. And there were some narratives around that, but when you tried to dig deeper into what that meant, we didn't see the information. And Carbon Tracker also does reports on this remuneration and whether it's tied to, or not tied to any of the emissions targets. I think it's called groundhog pay, is that right? I'm looking.
Or just noses in the trough. Was that what the hog?
Or that's the
You
new
have to
one.
explain for others what a groundhog is. It's
Oh,
not
I mean,
an
I don't know what a
internet-
groundhog is. All I know is Groundhog Day in the U.S. where
Deja vu all
if it-
over
right,
again.
if it comes out, yeah, that's
Just
the
to-
movie.
We
But
have
if
to
you-
honor the French and their metaphors.
There you
too.
go. But
Anyway.
I could digress, but I think Natasha
Sorry.
wants to. It's okay.
Sorry,
Natasha
Natasha.
also wants
Yeah.
to weigh in on this.
Yeah, if I'm allowed to.
Sorry.
I think this is a brilliant, absolutely brilliant point. And one of the things that we have been asking companies as part of our engagements is whether they would consider adopting a Paris underpin. So an underpin is a concept where you just get no performance-related pay unless that issue is met. So Paris underpin, has the performance been associated with behavior that's Paris aligned? If it has, fine, then that unlocks all the other KPIs that you might use to determine your pay. But actually, the other point to make here, if I may, is the pay, which is based on EPS and other things, those come from the accounts.
Yes, exactly.
So
Right,
if you've
yes.
got net zero aligned numbers, I'm okay then with the REM, the bonuses being linked to those numbers. What I'm not okay with is where we've got bonuses that are now being paid out on what are arguably mythical numbers, right? And so I think, we had this in the financial crisis as well, were they understating the risks embedded in the loan books, and therefore you had bonuses being paid out on earnings which actually were ephemeral and actually soon would turn around and maybe those bonuses need to be clawed back. Are we in a similar situation where we're paying out bonuses based on kind of mythical performance that in due course will prove to have been ephemeral? Will we claw back those bonuses? So I think, this accounting issue pervades everything. If we can sort it out, then we say we're only going to pay bonuses which are calculated by on the basis of net zero aligned accounting.
Yeah.
Thanks.
Yeah, I think that's a good point. So I'll ask a few more questions of the panel, then we'll go to the audience. So Bridget, actually, kind of obviously in the same vein, how do you think investors should work with the auditors, the audit committees, to make sure that they're getting the information that they need in the audit reports today or next audit report season?
Yeah, and I think there's a huge amount of helpful work that's already going on across the market. We already touched on the ISSB, for example, and I think the bringing together of some of these standard setters, these reporting frameworks across the market is an incredibly helpful way for us to align expectations across the market of where companies should be disclosing and how companies should look to, as I said earlier, define what is and is not material for them as a company within that corporate reporting. I think sometimes, when that's happening on a case-by-case basis, that potentially, conflates a number of issues. And I think having bodies like the ISSB to bring that together around a standardized framework, at the same time as companies themselves are becoming much more acutely aware of what the material risks and opportunities within their own business operations and supply chains are. Those two things coming together in tandem, I think, are going to lead to the quality of reporting that some of those investors are looking for anyway. So I think my view is, engaging really actively through that ISSB program, engaging with those frameworks as they're emerging, and the various sort of roundtables and sort of consolidation forums, if you will, that are emerging across the market is an incredibly effective way to achieve the outcomes that investors want to see. Now, clearly, as those become more robust, more transparent and more publicly available for different sectors across the market, if there are companies that aren't reporting sort of information that is deemed to be material, then that begs different questions. I think the challenge is always, there's not a one-size-fits-all approach. Many companies that sort of look largely the same from the outside, you get underneath the hood of it, and of course they operate very, very differently. But through those sort of frameworks, the bringing together of those different entities through the ISSB and those other forums, I think we can expect to see much more standardisation and much more of the right kind of information starting to come through the corporate reporting.
Okay, Nick, you wanted to weigh in on that, yeah?
No, so I'm obviously very enthusiastic about the IFRS Foundation launching International Sustainability Standards Board. It will be a sister board to our existing board, as announced at COP last week. I think there is perhaps a misperception. I'm not suggesting, Bridget, you have, but just to be clear with everyone else, that the new board will have responsibility for climate, or it will have responsibility for all sustainability issues. Clearly, where these have consequences for items that are recognised, or where there could be liabilities on the balance sheet, those requirements will stay with the existing board, and it will not change those requirements. That what's required in the financial statements will remain there. Now, I think what will be important is that the two boards collaborate and coordinate, and they're not having duplicative requirements. They're having things which are compatible with each other, and that helps with the consistency of the story that companies, we hope, will be telling. But my expectation is, and my belief and my understanding is, that the existing requirements will remain within the remit of the board and remain requirements on companies today. But alongside that, great to have the complementary development of a new board, really.
Yeah,
I just wanted to say the point that Nick is making is so important, because the argument here, and it's true in the United States as well, you can take a similar approach to US GAAP, and SEC Commissioner Alison Heron-Lee, before she became the interim chair, directly referenced this work at the IFRS as an option, a path for US GAAP through its own regulatory processes to follow. So if we understand that these are financial issues, then within the mainstream requirements of US GAAP and IFRS, we need to get this straightened out. So likewise, we support the new Sustainability Standards Board with full force, but the financial accounts need to recognise these risks and assumptions. So I just really thank you, Nick, for making that point.
Yeah, I think we also have to remember that even if it's not in the front end under the ISSB, as they form their standards, they still have to see this information in financial statements.
Yes.
So we don't want to wait for the Sustainability Board, even though they're acting quite quickly, and I appreciate the importance of it. But with the financial statements need to show this today. And the more it's in the ISSB standards, then the more we expect to see it in the financials as well.
Exactly.
I think that I'll just ask the two investors, and again, the others can chime in if they like, a last question about, we've seen the commitments that are being made out of COP, money going, GFANZ, money going towards these net zero transition strategies or announcements or whatever you'd like to call them. What's in mind, and then we've also seen lack of transparency in financial reporting for last year, 2020. So what is in mind, what's next for investors coming up for the next reporting season in 2022, I suppose?
Yeah, it's a good question and very timely. I think I mentioned earlier, for example, that we sent out our most recent sort of engagement letter to the Big Four in the UK last week that was published. In that letter, the investors that signed made crystal clear that we're now linking our assessment of the disclosures in the financial statements to our voting. And at an AGM, we get 3 critical votes here. We get the reappointment in most jurisdictions, and it will vary. So with that proviso, we reappoint the auditor, right? The auditor works for shareholders, not the executive. So shareholders get a vote. And actually, I don't think it's ever happened before we've never not reappointed auditors. If you look at the voting statistics there, it's generally well over 98% reappointment every single time. That's not an election, right? Nobody is actually even thinking about it. It tends to be rubber stamped. And the proxy advisors are partly to blame here. They need to start really doing some analysis of the auditor's performance. And I think that will be a good thing for auditors as well, because I think with that kind of scrutiny will come competition, and will come an interest in what shareholders actually want the auditors to do. Okay, so that's a very important vote, and I think you're going to see more votes against audit firms, where it's appropriate, of course. Secondly, we get the director votes and audit committee votes, and that's another really key area. So I think last year, for us at least, we have an amber list, our kind of high-risk companies. We voted against over half of the auditor reappointments on that amber list because of climate issues, and likewise for the audit committee chairs, same thing. So audit committee chairs will be scrutinized for their oversight of this. And finally, we get to approve the financial statements. I would say that's a slightly a softer touch vote, but nevertheless, it's a way to signal how happy we are with those financial statements and the annual report. So the three important votes, and I think that's going to be coming up this proxy season. The other thing I wanted to say, just looking forward, is the role of the regulator. We do have right now a situation where existing rules and requirements are not being enforced. And it boggles the mind, really. I mean, we need to see more enforcement. We need to see the Financial Reporting Council in the UK, but others elsewhere, the SEC, Anne mentioned, step up and actually enforce existing rules. So that really needs to happen. And I would add one final point, which is policymakers who are gathered here at COP. They've probably, many of them, jetted off already. Hopefully not jetted, but gone. You know, they need to make clear, we've said that this is, in our view, an explicit requirement under the rules we have here today, whether it's company law or the standards. But, you know, we will save time, and we need to save time. So policymakers need to come out and make absolutely crystal clear that net zero aligned accounts are mandatory. No ifs, no buts, no debates about materiality, it's just mandatory. And that would be entirely consistent with net zero statutory objectives. And in fact, it would be weird to have accounts that could be not net zero aligned when you have a net zero legal requirement elsewhere. So those would be the 3 points I would say in terms of going forward.
Okay, thank you. Anne?
Thanks. Natasha summed it up brilliantly and has done so much fantastic work in this area that we've all learned from, including ourselves at CalPERS, so thank you. 2 thoughts here. Making a commitment is not the same as doing it. And one of the things I love is, I don't know, my first job in life was as a barmaid, so the thing of beer mats goes right back to the first time I earned any money, paid my own way. But this basically is someone saying, I'll quit drinking by 2050.
Nice.
Yes, it's the prayer of St. Augustine, isn't it? This goes back many years for us lapsed Catholics. Lord, make me pure, but not until tomorrow. So the issue of all these commitments being made, it sort of puts the mood music into play. But the question of holding boards accountable, as Natasha's saying, holding auditors accountable, and I'm afraid to say also, guess what? This is true for investors. Mm-hmm. We need a sense of accountability for the investors who made statements. Now, we at CalPERS, I think we were the first, certainly we were the first US pension fund to sign up for the United Nations Net Zero Asset Owner Alliance. Okay. But what we have to be really careful about, this isn't about us getting a squeaky clean portfolio that makes us look good. We've got to get the net zero in the real economy. And that's why the accounts in the companies are so important. So if we don't have that same sense of accountability with the investment managers who are often making the decisions, and CalPERS 80% of our portfolio is internally managed, so we're in a different position. But for most pension funds, they're using external managers. So regulatory oversight of what is said and what is done is going to be as important for the intermediaries as it is for the companies. So, I have to finish with good advice, certainly from my grandmother, which is fine words, butter no parsnips. And the fine words, we can feel we've got plenty of that. But if we don't actually get this done, then it's all for nothing. Which is back again, full circle to the accounts and the audit, because without that financial alignment, we can't test what's going on in the real economy. So, thank you to everybody who do fantastic work in this area, and let's keep action in mind, not the warm words.
Just the words. I lied. So, Bridget, I'm going to come back to you. I'm sorry. I just want to push a little bit back and ask you if you think we might see more information in 2021, the audit reports next year for 2021 financial statements. And if I put you on the spot and you need some time to think about it, I can go to the audience.
It's absolutely fine. So, I think there is a building recognition across the marketplace that companies need to be thinking about this differently. So I talked about this revolution and this seismic shift that's happening, in all of us, I think. We're all on a journey here. We're all heading directionally towards greater understanding. And that is true of all of the FTSE boards that I'm working with, their management teams. Nick talked about the need to align strategy, risk, finance. That's true within those organisations, and those working groups are being formed to really fully, properly share that information between themselves to address some of how those systemic risks cut across and intersect their businesses. That is all happening, and it is providing a different layer and lens within those companies to enable them to report in all the ways that we've talked about today. So better reflecting their net zero targets in the front half, better reflecting some of the commitments they're making as companies in that front half, better articulating some of those scenarios, some of which are 1.5 degrees, some of which are 2 degrees in their front half, and of course, being in a position to start to really reflect that into both their management judgments and estimates, but of course also their impairment and sensitivity analysis as well. So I think we will see movement and certainly better reflection and articulation through that front half reporting of a number of that sort of TCFD type principles, which obviously a number of corporations, whether they're in the UK or not, are starting to adopt, and that will naturally start to impact the way that the reports are pieced together.
The audit reports. Okay, thank you. Anne wants, sorry, I knew I was going to do this. Anne wants to come in, and then we're going to the audience,
really,
I promise.
Back to the people. So I just wanted to come back to the good old Climate Action 100 plus benchmark and underscore the importance that we've not only for the first time included the just transition indicator, which is based on the ILO principles. We've also got accounting and audit in the benchmark. So I think this is really going to be a practical source of help, Bridget, for when investors are trying to make head and a tail of the audit report, the financial statements. We'll actually, with the help of the analytical brilliance of people like Barbara, we're actually going to be able to take these IASB standards and the stuff that's been on the books in the SEC since at least 2010 around climate risk. Because investors need help saying, is this what we should expect? How do we measure it against other companies, and how do we measure it over time? So that's, if you like, the piece of string. We've got a benchmark now, and I hope investors, companies, and auditors are going to find that practical work really useful. So that was just my last little bit. Thank you.
Thank you. Okay, let's open it up for questions. Oh, this is so exciting. So Helena, are you in charge of just going around and... can we first to the yellow, the lady, the woman?
Honourable member.
Honourable member
of Parliament. We're very honoured to have you here.
I will do So I'm Chion Wara. I'm the Member of Parliament for Newcastle Central, and I have to leave in 8 minutes.
You
Is
can,
it-
okay.
Yeah, I have to leave in 8 minutes to get a train
Thank
there.
you.
So thanks very much for coming to me first. And it's been fascinating discussion. It's something I'm also the Shadow Business Minister for Digital, etc. It's been fascinating hearing what you're saying. One point of clarification and one question. So you talked about 100 companies having 80% of global emissions, but is that, you're really saying that 100 companies are responsible for 80% of all emissions on the
Industrial
planet?
emissions.
Industrial, not services, so manufacturing and industrial. I just like to know exactly what that was, because it's something I might quote.
Yeah.
And then the other point was that, I hear what you're saying, that I think you're saying two things. Existing accounting standards, for example, a forward-going, risk-based, continuing, they all should reflect carbon risk,
Yes.
climate change risk, and that's not happening now.
Transition risk, yes.
Yeah, but also that there should be more reporting, carbon-based, about climate risk and carbon risk. So that's what my question is. What should governments, Natasha talked about policymakers, very specifically, what should I be expecting our current government to do? But also I meet regularly with the Institute of Chartered Accountants, England and Wales. What should I be expecting them to come out with?
I think
Natasha, you want to go first?
Sure. So the ICAEW, as you mentioned, is really a professional organisation, but an important one in moving the market. And I would say that they need to more proactively make very clear to members that under existing standards, as we've been hearing, particularly from Nick, that they should be integrating climate, and particularly a net zero scenario, into their disclosures to investors. And that can be in the notes to the accounts if it's not in the core accounts. Policymakers, governments, investors published a position paper. I think there are about 4 trillion of AUM leading up to the COP. Very clearly, it was a 2-pager saying government should mandate net zero aligned accounting disclosures.
Yes.
So that's what we want governments to do. We want them to come out. That was sent to Alok Sharma, President of the COP, as well as Mark Carney. We're awaiting a response. But that would be a very easy thing, we think, for governments to do to drive this forward.
Yeah, fully agree. Certainly from a pension fund angle.
I mean, it's interesting. I mentioned the ESMA enforcement priorities, which were published at the end of last month, which clearly apply to the European Union and not to the UK any longer. And there they're explicitly talking about Paris aligned. In terms of what should be reflected in the financial statements. I'm not sure whether the FRC is quite there yet on that in terms of specifically UK companies, which would time with what Natasha was suggesting.
Yeah, so for CalPERS, obviously we're a US fund, but we've got huge investments in the UK, like many other countries. Net zero aligned accounting and audit. That would do the trick. So thank you.
And I just want to clarify, so the companies that we looked at in my report, the 107 companies, those are not the 80% emissions, industrial greenhouse gas emissions. The companies we looked at form part of the 167 CA 100 plus companies. The 167 CA 100 plus focus companies are the ones that are responsible for 80% of the industrial 80. Yeah, so not the ones that we looked at in our report. They're part of that population. Sorry?
It's a big chunk of that cohort.
Yes. Okay. Thank you.
Thank you.
Do you want to just hand them? Did we lose the mic? Okay, we'll hand.
Yeah.
Oh, okay, we're
Go to
Handing over
Damon.
next. I'm being told who to hand it. Well, you tell. Why don't you just tell her?
Well, we have the AFL-CIO in the room, so come on. And you might be on the same train.
Thank you.
That's very kind of you. I'm Damon Silvers. I'm the. Do I stand up? Yeah.
Sure.
I'm Damon Silvers. I'm the assistant to the president of the AFL-CIO, the American Labor Movement. And as Ann said, I served for many years on the PCAOB Investor Advisory Group and on the oversight panel for the bank bailout in the United States. And as someone on the panel said, this does remind me a little bit of the conversations around auditing and accounting standards and the financial crisis, in the sense that both before and after the crisis, it was quite obvious that the financial statements of the major banks were just a complete fiction.
Yes.
And nobody did anything about it, either before or after. And the consequences of that were extremely severe in terms of the public and the investing community's confidence, not just in the financial system, but in the financial reporting system. Now, with that in mind, I just two thoughts or comments or questions for you. One is, what are your plans collectively to bring what you presented this morning to the new leaders of the PCAOB in the United States, the Public Company Accounting Oversight Board? The new chair, Erica Williams, I suspect, would be very interested in what was just said here. Secondly, I want to pose a question, and particularly to Bridget, which is, we've heard a lot in this presentation about net zero and 1.5 and Paris aligned, but what about the question of whether or not companies are describing worlds in their accounting statements that cannot exist, right? I mean, you can say, well, we assume Paris, or we assume net zero, we assume not net zero, right? We're going to go off on our own world somewhere else. But what if the assumptions inside these statements simply cannot be squared with each other? And how does, like for example, how does KPMG think about that question?
So should I answer for? Okay, so thank you for bringing that up about the PCAOB, because actually that is an important issue for us. So the International Auditing and Assurance Standards Board that oversees the audits of international standards on auditing, basically those are the companies that are being audited outside the US. That's a generalization, but more or less. PCAOB oversees the audit standards inside the US. And the IAASB, I mean, this is crazy, right? That is the Auditing Standards Board. They came out with clarifications, and they said, look, auditors, if it's material, you need to consider this in your audits. So they were very clear on it. The PCAOB has said nothing. They've been silent. And we've seen significant differences in audit reports in the US and outside the US, to the extent that auditors that are, audit reports in the US say nothing about climate change at all. Even, like I said, Exxon, Chevron, you know. And we've seen audit reports of companies that are global, so listed in the US and outside the US. So they have two audit reports, believe it or not, one for international standards, one for US standards. The international standard report talks about climate, and then a lot of the auditors took all those words out for the US audit report under the PCAOB standards. It's the same audit, same company, same audit partner. So, and the audit standards aren't that different in this respect. So, in a short, long answer, we want to talk to the PCAOB. We've been talking to the SEC, but I think we also need to start talking to PCAOB. And I don't know. I'm happy to get an introduction from either one of you. I mean, I'm sure that we have, but please.
So the PCAOB is the Public Company Accounting Oversight Board, which was set up in not even the last but the one before that, financial crisis. And not only is that vitally important for the world's largest capital market, but has inspection responsibilities in other markets, and just even being sorted out right now with China. The former members of the Investor Advisory Group wrote recently to the SEC setting out a to-do list for the new PCAOB, which includes a focus on investors and important matters like climate risk, and also I don't want us to keep forgetting about human capital management either. We're not just talking about risks and opportunities around natural capital, but human capital too. But that letter's on the website. I also think it's very important to note that Cara Stein is one of the new members of the board. She was a commissioner, I think actually, who appointed both Damon and me to the Investor Advisory Group at the SEC. And she's been doing fantastic work at UC Hastings on these issues while she's been sort of waiting for her next day job. So we're expecting great things. The PCAOB is back. All we need now, please, is a permanent chief accountant at the SEC. And, you know, the band has been reformed and we can get a lot of good work done. Sorry, I know there's a question
No, it's good.
for
It's good.
Bridget as well.
Yeah, should we go to Bridget, please?
Yeah, absolutely. So thanks for the question. I think the really exciting thing that the Task Force on Climate-Related Financial Disclosures, or the TCFD, has done over the last couple of years is to set out a framework which helps companies to consider those kind of out of bounds or those bookends specifically related to temperature outcomes. And that's a really different framing of a standard enterprise risk management framework, which is looking at risks either in isolation or without that kind of reference point of what that means for those broader systemic risks that I spoke about at the start. And that's a really important development because those bookends allow us to then consider how management's central judgments and estimates correspond to a given temperature scenario by reference to the counterfactual assumptions that would outturn under each of those bookends. So, you know, at the moment I'm actively working with a number of companies across both the FTSE and the Fortune 500, and that's a really active part of our dialogue is, you know, we're not just doing that scenario analysis, but we're really considering, you know, what are those key judgments that could impact on? How does it change them under different scenarios? How sensitive are they? And we're really making sure that that's reflected in management's thinking through that advisory work that we're doing. So I think you making that link between temperature and those risk sensitivities is a really important step and something which is actively happening now across many companies.
Oh, sorry, Natasha wants to answer that, and then we'll go back to...
Hello? Okay. I'll just make one additional observation because, you know, Bridget, you focus on TCFD, but what we are talking about the financial statements. And one of my greatest fears is that all the work done on the narrative side becomes a bit of a smokescreen, or at least an excuse to delay. And I think your point was very well made, which is, you know, and I had drawn that parallel with the financial crisis because this is about plain vanilla misrepresentation. That means action needs to be taken today, not tomorrow. If we have a situation, and maybe it's easier to frame it in terms of the energy transition rather than climate change. The energy transition is underway, whether we like it or not. And so the BAU, the business as usual assumptions, are just wrong. So therefore, are accounts potentially misrepresenting today? And the regulator needs to deal with that, and indeed auditors need to deal with that today, irrespective of TCFD.
Just to be clear, I think Barbara said at the very, very beginning that that isn't a part, I believe, today. Management assumptions, as we're considering them, management assumptions, what is part of the TCFD, and what I've sort of said is, you know, what we are considering today is how those assumptions relate to those potential sensitivities. That is happening across many companies today.
So in the sense, sorry, for the sensitivities, I mean, do you think auditors would be able to challenge management to put those types of sensitivities in the financial statements? So if management's using business as usual assumptions and estimates, because that's management's best judgment, can the auditors challenge management to do a sensitivity analysis to Paris-aligned assumptions and present that? I mean, is that how hard? I guess, you know, is there? You think that? Have you had that conversation, or do you know if auditors have had that conversation with management, and how difficult is it to get management to do that? Have you had any insight into that?
I mean, I think there is a distinction between having a sensitivity of a 1.5 degree scenario and having a central assumption of a 1.5 degree scenario. And I think we are working in a world that is still aligned towards something in the order of between 2 and 3 degrees, and that's been widely reported, I think, in the last several weeks. We might all like to be operating in a different world, and indeed, to the point made earlier, perhaps it's critical that we are working in an alternative world. But we are not in that world today. And I think a really important part of the developments that are ongoing at the moment is that we are creating those sensitivities to allow that consideration.
Okay. All right. Thank you.
Can I just on that very quickly? So I think the sensitivities are very important, but this can't rest on corporate reporting alone. You know, for people to have more certainty about the way forward, it requires on policy.
Yes.
We need to know how we're going to get there. What are going to be the different rules and regulations? What are the taxation implications? And as we have that, companies then have more certainty about putting numbers around that. So financial reporting has a role to play, but it can't do this by itself, clearly.
Financial reporting is should not be the thing that's shaping company activity. The actions of the companies should be changing. I mean, if the IEA came out and said no new, oil and gas production, so okay, maybe the policy isn't there, but companies also need to change. The financial reporting should follow that, along with policies.
I think once you have more certainty about the transition, it becomes easier actually for then people to put numbers around it. So at the moment it's about flagging risks, about assumptions that are being used, about scenarios. So those things are all important. But I think this is one of the paradoxes we have at the moment, that we know where we have to get to. We don't quite know the roadmap by which we're going to get there, but actually understanding where the risks are, the assumptions. It goes back to me, to understanding the assumptions that companies are using, then investors have the information to judge themselves. Is that aligned with their view of the world?
Okay. Let's go to the audience, because I keep, okay, let's go back to the audience. Sorry, guys, I know it was just getting exciting. Let's go back to the audience, and then we can keep going if we have time. So we have these two gentlemen who've been waiting. This gentleman first up here, and then in the back. Thank you.
Yeah, thank you. It's been really illuminating, this panel today. I'm Alex Wilkes with the Sunrise Project, and we are helping drive some of the accountability that you mentioned, Anne. And we will be encouraging investors very much around the world with our partners, via our partners, to vote on the kind of routine votes that you mentioned. But I think it's really shocking to me that 6 years after the Paris Agreement was signed by 196 or whatever it is, governments were still in this situation, and that your report shows a sea of red check marks against so many leading publicly listed companies. And so I think the accountants and auditors have a lot to answer for, and you're very, very far behind the curve. And the people out there demanding more accountability of governments and everyone, I think the focus and glare of public attention, potentially lawsuits by pension holders and many more things besides are likely to be raining down on your heads. If you go at the slow pace, which I've heard you talk about today, things coming together over the next number of years. So I guess I have a predictions exercise I'd love for the panel. When do you think the 107 companies will all score green on the 6 metrics that you've done? And also, what number of audit committee chairs will lose their seats from those 107 companies at the next vote? Thank you.
Can I add an extra thing to that mix? I'm happy to not make a prediction. I can tell you what our goals are. Our goals on the Climate Action 100 Plus project was that all of the cohort of companies would have boards that had accepted their responsibility to redo strategy, get their political lobbying in line, develop a just transition, these elements. Secondly, to set targets for net zero, and thirdly, to disclose how they were going to get there. Now, Oliver's here with the details, but Bloomberg New Energy Finance just sort of got their spike abacus out and totted up. We've got 111 of those companies now with the net zero target. So their question was, well, what difference would that make if we can, as investors, get those companies to achieve what they've promised? It adds up, and this comes back to our honourable member's question, according to Bloomberg, to 25% of global emissions, about the same as the annual emissions of China. So getting this done, I think, is going to be a mix of all of this. First of all, civil society has a huge role, because that's how we get the policy, and if we get the policy, we get the regulations. Investors have a huge role. The labour movement has a huge role. Each one of us, what we eat, how we get around, how we vote, how we spend our money, is all going to be part of getting to that goal. But the companies we've chosen, I think that's where we're willing to put ourselves forward and say, hold us accountable for that. But the other bit I wanted to add to your important question is about private markets. One of the things that's happening at the moment is public companies are offloading assets, and so are investors offloading assets into private markets. Yeah. And there's a sort of out of sight, out of mind concern here, certainly for us. So one other initiative I just would invite people to take a look at, and we'd love your comments, is CalPERS has teamed up with other LPs, as we get called, limited partners like APG, CPPIB, the big Canadian pension fund, and others, to develop a private equity data convergence platform on ESG, which we launched a few weeks ago. And greenhouse gas emissions, job creation, diversity, health and safety, renewables are in the mix for that platform. So we've got to have this same conversation about private markets, and I know we haven't had time yet, because in the US, the regulator doesn't oversee private markets in terms of that information, so it's a real gap we all need to think about.
Natasha?
Shall I just add, I don't, you had a specific point, which is when will it go green? You know, I'd like to think next year we'll see some really good, or really big, votes against auditors, audit committee chairs, financial statements, where they are just clearly not aligned. And I think that that will generate a ripple effect, even if that only happens at, let's say, 5 high-profile companies. So I think that has to happen, and that will help it go green. But I'll go back to a point I made earlier, which is if governments mandate this, and it's an absolutely obvious thing for them to do, in fact, it's hard for me to understand why they wouldn't do it. So that would be my question to Alok Sharma and Mark Carney. Why is this not part of TCFD? Why? Because if that happens, green will happen much faster. Thank you.
I mean, I would say, too, I mean, we have, you know, the auditors are coming to the table. They're talking to us, or we're talking to them. We're all having this communication now. So that's, yeah, maybe it should have started earlier for all of us, but it's, at least it's happening. And you know, we have to make sure that we hold the companies are, in my view, responsible for making this change as well. So they have to do it, too. Yeah, and I have to say, if I could predict, I mean, honestly, I think maybe instead of 70% of companies, maybe we'll see 50% of companies next year. I hope I'm wrong, but I'm not 100% sure. There's someone in the back, sorry, that's been waiting.
Hi. I'm going to give a health warning before I say who I am, because this isn't meant to be rude. But I'm a very frustrated asset owner. I am Doug McMurdo, Bedfordshire Pension Fund Chair, $4 billion AUM, 70,000 members. I'm also the chair of the Local Authority Pension Fund Forum, which has 4 members, LGPS pension funds with $400 billion of AUM. And our agenda is about the E, the S, and the G. So I'm delighted to see this panel. We've got the gamekeeper and we've got the poacher. What we haven't got in that 6th seat is the police officer. And this is where I'm now going to direct frustration to you, Nick. And maybe you want to take cover at the Anderson shelter. But this subject around financial reporting is dear to our heart at LAPFF. And we have employed George Bumpus QC, who's taken to task the FRC, and Natasha has been ably assisting my colleague Tim Bush in the background. But it is very, very, very frustrating. So Nick, you must wake up in the morning and think you've spent all of yesterday wasting your time writing the regs Well, I suggest you are, because it's not being enforced. And then I will just briefly turn my head to Bridget and just remind people, and I don't gloat on this, but let's just think about Valerie Patisserie and Carillion. These could have been identified many, many years previous if the auditors, and I go to the point, and you make the point, investors have a responsibility in this. But this is people, communities, and society. We really need, and to your point, you know, you're behind the curve as laying down the regulations. I think you need to be the police person as well.
Did you want to, I'm sorry to interrupt you. Would you like to ask a question?
Yeah, so well, the question is to Nick, you know, what are you going to do to get better enforcement? Because it is lacking.
Thank you. Well, I take a more optimistic view of the world when I wake up and think about how we can move forward and improve things. And I think the work that we've done in terms of illustrating that accounting standards do speak to climate risk as being very informative to the investor community. Yes. It's allowed us to build the momentum and to then have engagement both with companies and auditors. And auditors are very much part of the solution here as well. We need them to help make this happen. So I am more optimistic. I mean, as I said at the start, I tried to be very clear. The International Accounting Standards Board operates in a privileged position to be able to set standards in 144 countries around the world. It's been a great benefit to many economies. It's brought down the cost of capital, particularly in developing markets, by having transparent, consistent, globally comparable standards. We don't have enforcement powers. That is not the mandate given to us. It would be too powerful a position in a democratic environment to give a not-for-profit private sector organisation, which is what we are, both the right to set standards and the right to enforce them. Countries choose to use our standards. It's nothing we impose on any country. They choose to take our standards. But the enforcement responsibility remains with those local, each jurisdiction. So in this country, it's with the FRC. In Europe, it's with each jurisdiction, it's with the SEC in the States. And that's the right balance. Now, I empathise because we need to then be coordinated and collaborate and make sure that we have sufficient communication that expresses, right, here are our standards. Do you, as enforcers, fully understand them, what they are and what they are required to do, so you can carry out your enforcement responsibilities? Now, I mentioned also earlier the words from ESMA, not applying to the UK now that we have left the European Union, but those were very strong words from ESMA that were published last week in terms of giving direction here. And it does speak to conversations that sometimes happen in public, sometimes happen behind the scenes between standard setters and enforcement organisations. But those were, I think, were very strong words. They gave a very clear direction in terms of what the standards require, reinforcing that point, and what is expected. Now, the FRC, and we know the FRC is currently going through reform. That is in transition. The FRC, as it stands, has already made it clear that this is a focus for them. And I would hope that we would get the similar momentum in the UK. I think what's good from the work that's being done by Carbon Tracker also is that it's started to highlight better practice examples, perhaps not so far as best practice examples. It's starting to set a benchmark. And I think that's also helpful as we move along this route. So one of the reasons, finally, it's been a long answer, that attracts me to this world is I'm not an accountant, I'm an investor, it's not my natural world. Is actually this is an opportunity through reporting to make change, to ensure we have an appropriate and a better allocation of resources, because we know resources are scarce. And to me, that's why I come with and try and come to optimism with this role rather than pessimism.
I mean, I think just to kind of round that out, I mean, we all have a role here, right? So we all have to make sure that we all play our roles. We can't just point the finger at one. I mean, anyway, are there any other? Oh, I don't know. I'm not going to let these people ask. There's a person towards the front. This young lady in the white. And are you asking a question too? Okay, first we'll have this young lady here.
Thank you. I guess that it was not related to his question, but I think it's going to end up being. I know that we're perhaps not in the in a position or in a moment that regulation exists that is enough to be the basis of it. But I'd like to know your opinion if you think that this could be a new frontier for climate litigation. We've seen that civil society has been like extremely active, and perhaps even the inconsistencies or the lack of disclosure, this could imply responsibility of auditors or even companies.
Sorry.
Uh-oh. Go ahead, Natasha.
Yeah, I'm
sorry.
happy to take this. I do think litigation is absolutely clear and present as a occurrence, danger, however, depending on your perspective on the issue. I have mentioned a few times the requirements around misrepresentation. That's in the law today. So I think there's a question there as to whether we do have that. And I think that's why the regulator needs to get involved, and potentially there's an issue of litigation there. The requirements about adherence to true and fair view, so Doug sort of alluded to that, are the accounts that we're seeing presenting that. And that's not just about compliance with the standards, of course. That's about going a step further under the law, and that's a law not just in the UK, but also in the EU, and actually you find it dotted around globally. Whether taken as a whole, these accounts are giving us a true view of the economic picture of the entity. So there's potential litigation risks there. So I do think that that's very real. And in fact, I know that there are groups that are looking at that. So thank you.
We have Mr. Campanelli is asking a question.
Yeah, no, I'm allowed to say this as chair. It's been the most informative session I've attended at the COP. I wish I could say it was the most enjoyable, but the issues that you've raised are so important and so serious that they require deeper reflection, because what we've heard from the presentations and the discussions is investors by and large are not seeing the whole picture of what's really going on with companies, and we haven't quite got this right. And the weekend before I came here to the COP, I joined a session of climate specialists, one of which was a lawyer, and they said that one of their jobs and their colleagues has been to strip the word materiality out of any of their climate-related disclosures. And they're doing this systematically, and you kind of echoed some of the British kind of US differences. And I think the reason for that is we've got an unstoppable force hitting an immovable object, and that is the size of the assets of the fossil fuel system we've built up over 200 years. Carbon tracker, we calculate that at around $18 trillion of fixed assets, pipelines, oil rigs, the chemical plants, the steel mills, and we're going to have to lose about half of that in the next decade. I mean, to put that into context, that's probably 2 or 3 times greater than the size of the crisis of 07-08. So will companies willingly want to announce huge write-downs of their assets? And I think the answer to that is very clearly not really. So we've got ourselves a challenge here, and it's so important that we keep this focus. And I just wish we could sue auditors, and if we can, how soon can we start?
Is that a question, or I think we're almost out of time, but 30 seconds.
Not really
30 seconds. 30 seconds, and then we have to go to our closing remarks.
All right, it was more a statement, which is a great statement, Mark. But again, the litigation, there's a misrepresentation issue within the accounts themselves, but there's also this consistency point between the front half and the back half, and where you have companies saying, yes, we are net zero aligned, but then being radio silent in the financial statements. I think that's also contributes to that sense of we're being misled, because it's not true. You can't possibly be saying you're net zero aligned and then leave it out of the numbers.
Even snake oil sellers in the United States were pursued through the courts. First of all, for not having enough snake in the said snake oil. And the next round of litigation was because they realized it really wouldn't make your hair grow back or, cure you of whatever the ailment might be. So maybe we're just in the first phase. Snake oil in sustainable investment.
Okay, well, with that, we have closing remarks from David Pitt Watson, but first I'd like to just please join me in thanking again this panelists for coming. I really appreciate it. Thank you. And I'll let the panelists, you can leave the stage so you're not in the spotlight during, we have a video, or not a video, live closing remarks, and let me introduce him. Thank you, everyone. So, are these still on? I can just go sit. Oh, okay, you can hear me. So we have David Pitt Watson will be giving our closing remarks. And David Pitt Watson, is well known in the world of responsible investing. He's one of the founders and the CEO of the responsible investment activity at Hermes, so in which, in whose event we're taking place today. David chartered the UN Environment Finance Initiative in the run-up to the Paris climate talks. So he's been involved in this for a while now. He's been a partner at Deloitte and sat on the board of KPMG. And he currently leads the expert group known as the Climate Accounting Project, with whom we worked for our report. So let's have David's closing remarks, please. Thank you, David.
Thanks very much, Barbara. And I'll just take about 5 minutes maybe to try and summarize and think about some of the lessons learned and maybe add just a wee bit of color to what it is that we've seen at this debate. And I think it starts with this, that accounting and audit are absolutely fundamental and central to how our commercial system operates. Indeed, since you're in Glasgow, to add a little bit of color, it was because of an event in Glasgow that companies now need to get themselves audited. It was a bank called the Citibank of Glasgow that went down, having produced accounts that looked like they were all fine for several years, but they weren't. This was a Ponzi scheme. And after the collapse of the Citibank of Glasgow, companies needed to have their accounts audited. So we now have 3 million trained accountants around the world, hundreds of thousands of them, making sure that the reports that are giving to investors are ones that are telling the full truth. And we have what I think is a huge, some I think would say an appalling anomaly. And that is that although the company is charged with producing accounts and the auditor with making sure that they have done so, that includes all material risks, but there is little evidence from what it is that Carbon Tracker, the work Carbon Tracker has done, that the most important risk facing humankind has been considered when those accounts have been drawn up. And that despite the fact that over 100 trillion of investors, who of course are the audience for this account, have said that that's what they want to see. And of course, if that is right, it allows, indeed maybe even encourages, what I've heard some people call an environmental Ponzi scheme. You know, Carbon Tracker, very famous for saying, look, we've got stranded assets out there. These assets cannot be valuable, and therefore these companies will not be able to sustain themselves, leave alone the great damage that they will do to the environment on the way. So this anomaly must be addressed. And by the way, this is not a new thing. Barbara said I chaired the UN Finance Initiative in the run-up to Paris, and we launched the TCFD there, and that's now blossoming, and the ISSB, and that's absolutely great. But be clear, if what's in the ISSB is not reflected in the financial numbers, then we're not clear about how much effect that's going to have. And I remember after Paris working with Christiana Figueres and Achim Steiner in writing to the IASB and saying, look, you have to address the climate issue in the way that the standards are implemented. And over the past 2-3 years, we're suddenly starting to get the breakthrough here. I mean, I must start with Nick Anderson, whom you've heard from, and I think has been absolutely crystal clear that climate needs to be considered and assumptions shown. He's been followed, as people have mentioned, by the IAASB, the Audit and Accounting Standards Board, and indeed by the FASB in the United States. They've been encouraged to do that over several years by investors. You've heard from Natasha, who's been an absolute pioneer in all of this, and Anne Simpson from CalPERS. But they've been joined by every big investor group, PRI, IIGCC, Ceres, ICGN, AIGCC, a whole Scrabble letter of investor groups. And BlackRock also, by the way, is saying that this is what they want, that this is what they want to see. They want to see the standards applied in the letter and in the spirit, and they want the assumptions used to be ones that are compatible with a sustainable world. And that, I think, is what we will see picked up by Climate Action 100 Plus in their benchmark. So this is now very, very much on the agenda. And that's the good news. But there is bad news. The thing that Barbara started with is saying that despite all of this guidance, despite this clarity, this isn't happening. Now, I don't think that's because there are bad people. I was on the board at KPMG, and it's full of people like Bridget who have devoted their lives often to thinking about climate and to making sure that financial reporting is as good as it can be. Indeed, the big six themselves have made public announcements that they are going to follow the guidance and then have not done so. They've joined the GFANZ, the Glasgow Finance Alliance for Net Zero, which says that they were committed to net zero, and yet we're not seeing the information that we want from the financial reports. So how do we fix this? Well, there are quite a few players in all of this, and let me just touch on some, but dwell on a couple that I think are the most important. I mean, one is the policymakers and the regulators. I should say that over the last year, Mark Carney has been extremely helpful in trying to draw to attention, both publicly and privately, this big anomaly and the need for it to be filled. So is the FRC in noting that in 2019, accounts in the UK did not meet the standards, and ESMA, as Nick has talked about, will be doing this in Europe. Commentators and campaigners, we need to focus on this. This is something that ought to be there, but is not. And if it's not there, as Natasha said, until we get 1.5 degree numbers, we won't have a 1.5 degree world. And I know that there are some litigators now who are thinking about where it is that they go with this. Companies and the finance directors, they need to be aware of it, and they need not to think that success is achieved by investing in stranded assets and then by massaging the figures so that they look as if it's profitable. By the way, it's those companies that have done this, and I would single out BP, actually. It's an oil company, but I think for this should be praised, discovered that when they did this, they also realized that many of their investments needed to be written off, and some of their future capex needed to be cut back. In the case of BP, I think it was $16 billion of assets written off. But if I had two groups where I think we do need to press this point, the first would have to be the auditors. The performance this year of companies and what the auditors were happy to approve without comment, I don't think was consistent with the standards, and therefore I don't think can possibly have been acceptable. I don't doubt, as I say, that the audit firms are full of people who in good faith are trying to do the right thing, the GFANZ helping with the establishment of the ISSB. But if I was still on the KPMG board, I think I'd say what I often said to them, which is, think about this the way the outside world would think about this. You're talking a lot about how much you respect the need to get the commercial system aligned with sustainability. But clearly, here is a material issue that we're not seeing how it's been included in the accounts. We're not seeing the standard setter a guidance in the letter and the spirit. And if you're going to be part of GFANZ, you need to do this. As some might say, you need to do the day job. And we don't have that yet. And I hope that we will have it, not in years and years' time. The standards are very clear. We need to have this soon, and we need to have it now. But the second group that I would talk to would be the investors. We are doing some work with the regulators, including talking to ESMA and all the rest of it. But the investors are the people who are the most immediate users of this, have the most immediate need of this, and indeed have the power to do things to make sure that we do get the accounts that we need. So climate action 100 plus is absolutely great. As Barbara said, I lead this little expert group called the Climate Accounting Project. We will give
David,
whatever support is necessary. Yeah.
I'm so sorry. They're telling me I have a 1-minute warning and then we have to clear the room. I'm so sorry to interrupt you.
That's fine. I'll be 45 seconds. So we'll give whatever support is necessary to that, and indeed to individual investors if that's helpful. But let me finish with, this should not be a fight. In Glasgow, the whole finance industry signed up to $130 trillion, signed up to the Alliance for Net Zero. This is a critical point that we need to take on the road to net zero. And I hope that auditors and investors and regulators and everyone else can work together, making sure that the financial numbers show what the standard setter says they should show, and that is net zero, and that the investors get what they want, which is a net zero numbers. And indeed, as Natasha said, if we can get that way, that is the surest way of getting us to a net zero world. So Barbara, thank you very much, and I hope I've left 5 seconds.
Thank you so much. Thank you everyone for joining us today. Thank you, David. Can I just leave you with this mantra? We're going to save the world one set of financial statements at a time. Anyway, have a nice day. Thank you, everyone.